I wanted to introduce today's guest very briefly, just welcome everybody here. Chris Jurgens from Omidyar Network. Welcome, Chris, and thank you for sponsoring. How are you?
Great to be with you.
Thanks. And Illinois State Treasurer Michael Frerichs. Michael, how are you?
I am wonderful today. Happy to be with you.
Great to have you. We're going to have by, I was going to say videotape, but I don't think there's any tape, but by video, we'll have Hiro Mizuno. And I think most of you have heard of him. He's now a UN envoy for innovative finance and climate finance, but he was the chief investment officer for the government pension investment fund of Japan. I think the world's largest institutional investor, now something like $1.75 trillion in assets. And we'll have some comments from him. Sara Murphy from the Shareholder Commons. Welcome, Sara.
Thanks, David. Great to be here.
And Michael O'Leary from Engine Number One. Thanks for joining us, Michael.
Thank you, David.
And Marcela Pinilla from Zevin Asset Management, which I think is based in Boston, and you're in Brooklyn. Is that right, Marcela?
That's right. Greetings from Brooklyn, everyone.
We have a good Brooklyn contingent at ImpactAlpha as well. So welcome, everybody. Chris, let's just set the stage a little bit. This is the second of 3 Capitalism Reimagined calls that we're doing in conjunction with Omidyar Network. We had the first one a month or so ago and worked over the whole context of worker power, racial equity, and a number of other themes. And this one is really around sort of shareholder power and stewardship. So tell us what Omidyar is up to with reimagining capitalism and what you're looking forward to today.
Thanks, David. So for Omidyar Network and for this Reimagining Capitalism series we're partnering with ImpactAlpha on, for us, it's all about how we bring about systemic change to the economy, how we shift markets to deliver better outcomes for society. And we think one of the most fundamental problems we need to address is that the rules and incentives in the system today reward decisions by businesses that generate short-term financial returns, but are harmful for people and planet. And so how do we shift this at a systems level? David, as you referenced in our first session this summer, we talked about policy change as a major lever on this and how we need to shift the overall rules that govern corporate investor decision-making. And today we're talking about how we leverage the power of institutional investors, and importantly, the individual investors that many of these investor fiduciaries represent, to address how companies are contributing to key systemic risks to the economy, notably climate change and inequality. And so I think you have a fantastic lineup of great speakers here who have been leading the charge on more strategic, systemic approaches to shareholder activism, approaches that seek to leverage asset owners and managers' power through active stewardship, through proxy voting, through direct engagement with companies to drive and shift how they address major externalities. And I think, as everybody on this call knows, these approaches have made real waves these past proxy season, and there's been some significant achievements that hadn't been reached before. And so excited to dig into that with the group we have here today.
Terrific. Thank you, Chris. The real theme that emerged from the sort of prep and reporting for this was sort of the importance of the perspective. Like, are we talking about, company level, portfolio level, or system level? And that I think you'll hear. One of the things we want to do, I don't know whether this is going to work. It's a little bit of an experiment. A lot of terms get thrown around, right? And we've been sort of beating the drum on them a little bit the last week in ImpactAlpha. Universal owners, beta stewardship, or just beta, negative externalities. Some of it can be quite wonky and confusing. I think, Dennis, I'm going to put you on the spot here. Why don't you start us off and just put some markers of these terms in the text, and then, folks, if you want to add your own glossary terms, we're going to compile a glossary for reimagining capitalism, as it were. So that's one thing you can do in the chat line. The other thing you can do is introduce yourselves. And that's become something of a tradition on these calls. Just who you are, where you are, shout outs from wherever, and maybe your organization, just so everybody sort of knows who's in the room. We've had, I think, well over 600 RSVPs, and I glanced at the list. You all are quite an impressive group. Any of you could be up here speaking, and we hope you will participate as we go along. Let's start with you, Treasurer Frerichs. Michael, your staff calls you Treasurer Frerichs, so that's what I got used to, but you said Michael is okay. So welcome. I was really keen to have, because when we talk about the public interest, you actually represent the public interest. You are an actual elected official in Illinois. So tell us what your charge is and sort of how you think of your, I guess, fiduciary responsibilities.
Well, I'll say very broadly that we approach investment quality and risk in a more rounded and expansive manner than perhaps was before. We have an emphasis on long-term value. So I get accused sometimes of pushing my politics or my own personal issues out there, my own personal values, but we look for value. So, and of course, we employ best practices in financial and technical analysis. We haven't stopped that. Then we also integrate sustainability factors, adding an additional layer to assess risk and value. Are you guys hearing a little bit of feedback? Is that from me or elsewhere?
Sounds fine to me.
Okay, all right. Well, we focus on sustainability or ESG factors that are material and relevant, as we should as a fiduciary. We look at governance and leadership factors, environmental factors. We look at social capital, human capital, and business model and innovation. So I want to make clear, this is not ethical investing, but it's grounded on a focus on financial impact. It just so happens that when we do that, it happens to align with my personal ethics. But this is backed by academic and practitioner research, demonstrating that sustainable companies perform better and provide reduced downside, something we as fiduciaries should be looking for. We also think this is common sense, that companies that align their business with the interests of workers and customers and communities, regulators and shareholders are best positioned for long-term success. Now, some investors are day traders. They're looking, they can hop in and out of markets, but I oversee retirement funds and college savings funds. People are investing for 10, 20, 30-year long frame.
And so let's pick up on a couple of those themes. One is long-term, as you said. A college fund. You want it to be there when your kid is ready for college, and the retirement, obviously. And then you said there's other values that you have and I think you consider yourself a universal owner. And you made the point to me that even those college fund and IRA 401k holders are universal owners because you are looking across the whole portfolio, across the whole economic system. I think there's a statistic that most of the returns you're going to get are a function of where the market's at, less a function of which index or which stocks you particularly hold. So how do you think of that system level, and what are you doing in a sense? I know you're working with other treasurers. What are you doing to try to sort of spread that perspective?
I'm involved in politics. I realize I don't get this office by myself. I have to assemble a good team. I work with a lot of people in organized labor. They get that you have to have a good team, that you are stronger working together. And I find that investing, we are stronger. We have more leverage when I work with other organizations, other state treasurers, and we have increased assets. So hopefully you align yourself with people who have a similar long-term view. So we work with numerous coalitions of investors to address sustainability risks and opportunities. Groups like Ceres, Climate Action 100+, the Human Capital Management Coalition, the 30% Coalition. But one key coalition that I've been very involved in is For the Long Term, which is a coalition of treasurers, primarily state treasurers. And we focus on addressing issues of mutual interest and ultimately protecting the long-term well-being of our beneficiaries. So For the Long Term is working to ensure that treasurers are coordinating actions. We share best practices, and we're effectively integrating sustainability into our processes. So our strategy is to bring together treasurers to maximize outcomes, disseminate best practices, and empower one another to better serve our individual constituents.
Is there an example of something you've gotten involved in an issue area that you've tried to, exert some of this clout, as it were, to affect some changes?
Yeah, we do this because we think that we'd like to have successes out there. We like to win running for office. And the one we probably had the first sort of big win was in the opioid crisis. We have seen numerous companies either go bankrupt, like Purdue, or face multi-billion-dollar lawsuits for their role in the opioid epidemic. So an analysis of ESG's factors would focus on the legal, regulatory, and reputational risk to companies involved in such unscrupulous behavior. I think people are familiar with that, but a more recent example is the impact of COVID-19. Recent events provide a perfect backdrop for the utility of our approach. This past year and a half has been very turbulent. Perhaps more than ever before, we've witnessed how companies and their investors are impacted by the onset of unconventional factors, like a global pandemic or the impact of climate change. We've worked with several companies to help them through this, to make sure they're managing their human capital or other risks.
And last question, you mentioned a little bit about the politics of this, but it seems in some way that like ESG and impact have become politicized. We used to think that they were sort of the ultimate, bipartisan and cross-partisan issue, but in recent years, as anything, things have become politicized. Is that a good thing, bad thing? How does that play out?
I agree with you. This should be bipartisan. We are all fiduciaries. We should be looking at all risks and looking to minimize risk. Unfortunately, this has become much more of a partisan issue. It shouldn't be that way, but I think that there are some people on the other side of the aisle who will say, your job is just make money and let the CEOs make their decisions. If you are just turning over all decision-making to the C-suite, then I don't think you're doing your job as a fiduciary. So when I explain what our office and other institutional investors are doing on sustainable investing, most people understand right away if they get a chance to explain this. But unfortunately, too many people hear those letters ESG, and if they know that E stands for environment, it causes some people of political variety to have their hackles up, and they're automatically opposed to it. If you can talk about the risks and break down the risks, and there are financial risks, and we have a responsibility to manage these issues and protect our investments, we can win people over. But of course, there are some people who try to label this work as political or based purely on personal values. But as I said, this is about creating long-term value. Most of you likely recognize this work is based on materiality and financial impact. Research and experience shows that ESG issues impact investment performance, and that's why we do this. And that's the message we have to get out to those who think that it's too political.
Terrific, Michael. Thank you. And stick around and listen to the others, and then we'd love to have you come back and comment on your thoughts on what you've heard. I want to turn to another universal owner, another institutional investor. You manage some billions. He managed at least some trillions. We're going to run a short conversation I had the other day with Hiro Mizuno. It's, as you know, in the middle of in Tokyo, unfortunately, so he couldn't join us live. But here's Hiro Mizuno, ex of the Government Pension Investment Fund in Japan. Isaac, can you run that? Welcome, Hiro Mizuno, to the Agents of Impact call. Thank you for joining us.
Well, thank you for having me.
What I wanted to ask you again was how this concept of universal ownership plays out in the real world of institutional investing.
We just felt like, we should find a way to make a contribution to make the whole system or whole universe of capital market more sustainable, right? So I think this is sort of like the kind of a step up for the institutional, the investors from paying attention to what's happening in the portfolio they own to the world surrounding the portfolio that we own. And one of the conclusion I reached in the end was, whatever we do within the portfolio we own, that cannot be totally segregated or insulated from what's happening in the world. Right, so that's where the universal ownership and the philosophy kicks in. The investor should pay as much attention to what they don't own as to what they own. So that's the real philosophy of universal ownership. We are all, at least collectively, we are owner of this universe, right?
There's a notion too of beta, that, as you say, that the risk to the system and to the risk to your portfolio company, some of that risk may come from other companies in the portfolio.
If we are making money by investing in a company who actually produces a lot of the negative externalities, who have to pay for that cost? If not paid by other company in the portfolio, somebody else have to pay for it. And usually what happens is the government or like a community have to pay for it, right? So we have to be responsible for all the activity of the portfolio we own, impact on the rest of the portfolio or rest of the system. So that's what it is.
Actually getting these asset managers to move on some of these negative externalities in the portfolio companies turns out to have been harder than maybe you'd have expected. People think if you're the asset owner, you should be able to tell these asset managers what you want them to do, but it's not always that easy, right?
It's a kind of like a vacuum of responsibility. That's how I called it, because everybody is just focusing on how to be better than the index, right? Or focusing on how to track the index without any tracking error. But who's responsible for that index? Actually, nobody, because let's say like a market cap weighted the index goes down due to global economies really going down or hit a crash, right? Who's responsible for that? The asset managers, they are paid as far as they perform better than the average, and the passive manager, they are paid as far as they track down when the system is going down. And the index provider, do they feel responsible for that? No, they wouldn't, right? So I think this system we created or developed, our industry developed, like indexing and the tracking, passive or active, and asset owner also measure their performance against the market beater. It just created the vacuum of responsibility, right? So we just need to make sure we are collectively responsible for what's happening to the whole economy.
So not just alpha, but also beta in terms, and then sometimes as people have been telling us, you might have to disadvantage in some sense a portfolio company. The classic example, because it came up in a big proxy fight last year, as you well know, is Exxon.
Well, I mean, it was after I left the GPIF, but if I were still there, I would have asked the asset managers whether they are passive or active. How did you react to that, the shareholders' proposal on Exxon? Because it should manifesto what kind of like a ESG philosophy that the asset manager have, and what kind of like active stewardship, the procedure they have. So I mean, that kind of like a specific case. I don't know, because I left before that. But when I was at the GPIF stewardship team usually picked up several of those like kind of like the high profile cases of the proxy fight. And we asked the asset managers to explain why they acted that way.
I saw in some of your writing that when the GPIF did a kind of analysis of its own portfolio, according to the Task Force on Climate-Related Financial Disclosures, you found that you were on a 3-degree scenario, double the 1.5-degree scenario. The big owners, long-term owners, are supposed to have responsibility for the market, yet even the one that accepts that responsibility was busting the carbon budget. So how do we get to anywhere close to where we need to be on all of this?
I just told my team like, hey, okay, we are gonna play the role of litmus test, right? Because the GPIF has the biggest and most diversified portfolio in the world. So when we analyze our portfolio and it turned out to be our portfolio is actually in line with the 3.5-degree or 4-degree trajectory, that means world is heading that way. right? So if I'm managing a bit smaller portfolio with more flexibility, I probably trying to the shift the portfolio more drastically to invest in a low carbon type of the business or negative carbon type of business. But GPF has their own role.
Hi, we're back live here, obviously. And thank you to Hiro Mizuno in absentia. Sara Murphy, I imagine some of that was singing your song. But let's just start at some other place, which is there's been a lot of talk about stakeholders. We talked in our last Reimagined Capitalism call a lot about stakeholders. Your organization is called the Shareholder Commons. And in a sense, shareholders are being asked to be the sort of representatives of stakeholders. So just explain the sort of, big, broadest framework for what Shareholder Commons is trying to accomplish.
Yeah, sure. Thanks, David. And I'm delighted to follow Hiro because he kind of laid all the groundwork for a lot of what it is that we're trying to do. And yeah, I mean, you said it exactly right. Some of the sort of tensions, I think, in our world lately have been around, are we focusing on shareholder primacy or are we focusing on stakeholder primacy? And I think one of the things that we would say is that we're not even doing shareholder primacy right. We're not even doing our best to maximize the portfolio value of people who hold shares in the first place. And the reason for that is because, and this is well demonstrated, portfolios depend for something like 75% of their value on the health of the systems upon which they rely for their health, economic systems, social and environmental systems. We're talking about clean air and water, a healthy labor force, and so forth. That accounts for far more of the value of a retiree's 401k, of a college saver's portfolio, than any outperformance of a single stock within that portfolio would ever do. And that's why we sort of come back to this issue of, even just when we confine ourselves to the originally stated purposes and how we define fiduciary duty, we're not getting that right if we're not attending to systems risks, and those are created by corporate behavior that externalizes costs on the rest of the market.
And just back to our glossary and also to some of what Hiro was talking about, that system level or market level analysis is what people are calling beta, right? So we've obviously been impact alpha, but now we understand we maybe should be impact beta.
That would be amazing, David.
But,
yeah, exactly. And I mean, it's really just, this is not to somehow reject the good work that portfolio managers can do in seeking alpha. It's more to say, listen, if you pursue alpha at the exclusion of everything else, you're really not maximizing your beneficiaries' value, plain and simple. And just to be clear, the vast majority of investors around the world are diversified shareholders where this pertains, right? Very few people hold narrow holdings. So this kind of applies to everyone. And
that's what we just to put an exclamation point. That's what we've been saying is we're all universal owners now. Yeah,
that's exactly right. And there have been a couple people who have made this point in a few different ways. I think it was Ann Simpson who recently said that even if she sells her shares in, say, an Exxon, it doesn't shield her portfolio from the impacts of Exxon on the world and the companies within that portfolio. So this is really to say that investors should be holding the companies in their portfolios accountable to their systems level impacts. And just to give an example, we've got lots of investors out there in the world who are making commitments to climate change and reducing greenhouse gas emissions and so forth. So to take maybe an example that's a little less obvious, let's take something like a media company putting out information, or perhaps better said, disinformation and misinformation around climate change and around how that works. If someone holds that company in their portfolio, are those, prepare to clutch pearls for just a moment, are those bullshit emissions any worse than greenhouse gas emissions? Possibly, right? Because they're contributing to an entire political environment that allows that kind of thing to continue, that doesn't put into place the right checks and balances on those types of emissions. So I'm delighted, David, to take this opportunity to announce a new campaign that we're holding. We're going to be filing shareholder resolutions at media companies, specifically asking them to convert their corporate form to what's called a public benefit corporation, which would allow their boards of directors to take better account of those types of activities. And so we've started with Fox, the owner of Fox News. That resolution is filed, and it's going to be on their proxy ballot, which will be their annual general meeting will be sometime in November. And I got to say, it's really hard for me to imagine how an investor who stakes a claim around attending to sustainability issues and ESG matters could not choose to support that when it's so clear the systems level impacts that type of an activity produces, and really damaging the rest of the portfolio.
So you're making some news today and announcing this campaign around, I guess what we're going to be counting, not just greenhouse gas emissions, but BS emissions of
Exactly. And to be really clear, this is not to pick on Fox News, right? Because this is not just a Fox News problem. Really, all companies in the media landscape need to contend with this real tension around the fact that the requirements of their incorporation specify that their boards of directors have to attend to the very narrowly defined value that they return to shareholders, typically measured in stock price. And frankly, nonsense sells, right? Inflaming people's passions sells. It's actually a reasonably good strategy to increase revenues, but it is not good for the rest of your portfolio. So that's
I can see how that makes the negative externalities case. Leaving aside just that narrow, that specific issue, which I'm sure will get a lot of attention and people will chew over the various implications of it, and ImpactAlpha will as well. But just more broadly, what I want to pick up on is what Hiro Mizuno said, and this is something that is a possible nuance. It's not really a nuance, it's sort of core to the whole thing, but you have asset owners like Treasurer Frerichs, who manages the Illinois funds of various sorts, and like Hiro Mizuno, and like lots of pension funds, sovereign wealth funds, and whatnot. And they have asset managers. So when we talk about like BlackRock voting on a resolution, or Vanguard or State Street, they're really generally acting as agents of these asset owners. And these asset owners are really the universal owners who have to think about all of these negative externalities. So how, and this is what baffled me, can't the asset owner just tell the asset manager what to do? I mean, what is the sort of drivetrain there to action?
Yeah, I really think this could and should cut both ways, right? I mean, yes, asset owners are the ones who issue mandates, and their asset managers invest in keeping with those mandates. I think it certainly would help the more asset owners were willing to put a stake in the ground around exactly this type of beta stewardship, the more likely it would be that asset managers would chase after that and do a better job pursuing it. At the same time, I keep wondering, it seems to me that it would be a tactical advantage for an asset manager to say, hey, actually, this would be the best way for me to deliver value to you asset owners. And I'm going to go ahead and put forward this proposition really aggressively and demonstrate to you that this is actually the best way to honor our fiduciary duties and to return value to our beneficiaries. So I kind of think that the direction of travel is both.
Gotcha. And last thing, I just want you to introduce very briefly this notion of guardrails and investment guardrails, which I know you're working on, which I think will become sort of more of an interesting way to kind of encapsulate a lot of these ideas we're saying and sort of, in a sense, operationalize them.
Mm-hmm. Yeah, so the idea we're working toward is that investors should implement a series of guardrails, and that really is exactly what it sounds like, right? We're sort of running off the cliff on a couple really major issues. So the idea is to say, how do we just keep ourselves within those guardrails? This is a blunt instrument, right? It's not to sort of, we're so far away from managing these systemic impacts that this is sort of a first cut at just getting ourselves within the field of planetary boundaries, ecological boundaries, and societal boundaries. And so the idea would be that we put about a guardrail in place. Investors would manage their voting, their proxy voting, and their debt issuance in keeping with those guardrails. So vote no on directors, which is a fairly painful mechanism at companies, and so forth. And so to offer maybe a tangible example, another issue we're working on is antimicrobial resistance. And to give the real distinction between this approach versus what's been called ESG integration, which focuses on enterprise risk alone. A lot of companies have done some work, take for instance, the meat supply chain. They've done some work reducing the amount of antibiotics they use in raising their meat animals. But there's only so far they can go as individual companies before they sacrifice their own competitive advantage with the rest of the marketplace, because really they would have to make some changes in the way they farm. And they're not going to do that with the kind of pressure that has to come from either governments, which, I mean, I'm not holding my breath, right? Or in this case, investors. And so our proposition is that This kind of pressure should come as a relief to a management team that truly wants to address an issue, because it should remove the fettering that takes place when they're forced to operate within the profit-seeking motive and within a competition motive against their peers. If investors did this, it would allow companies to truly do what they know how to do, which is solve for the problems. So we think that if everyone is willing to just listen to what we're proposing, it actually makes a whole lot of sense, and it actually would protect value for everyone.
Great. So that's a good setup. Michael O'Leary, thanks for joining us. Engine number one, of course, is known mostly in the last year for the Exxon fight, and it's come up already several times on this call. In the lingo of sports, what do you got? What do you got next for us?
Well, many people know us, the Exxon campaign, and that campaign and really our entire firm is built on a very simple premise, which is environmental issues are economic issues. Social issues are economic issues. In many ways, we're trying to bring common sense back to capitalism, that when you invest more in your workers, in your communities, in your stakeholders, when you invest more in the environment, they'll invest more in you. And if you are the 5th largest greenhouse gas emitter in world history, as Exxon was, and if 2/3 of your emissions comes from countries that are themselves setting targets to reach net zero emissions, you don't have an ESG problem, you have a strategic problem. You have a big strategic problem. And if you care about long-term value, you need to gradually but purposefully start repositioning your business for a rapidly decarbonizing world, leveraging the scale and expertise you have as competitive advantages, but recognizing that the current path is unsustainable from a planetary sense and from a business sense. And our conversation on universal ownership is such an important one. I think our role as long-term shareholders, our role as an asset manager in this space is to work as active owners, trying to help companies create long-term value by focusing on the impact they have on their stakeholders. And we can do that through a couple of different ways. We can do that through voting, how we vote at annual meetings every year. We can do that through more collaborative work and engagement with companies. And sometimes we can do that through activist campaigns. That's most obviously happening right now on climate, both on the supply side of climate, the energy companies, also on the demand side of the energy markets, around transportation, agriculture, heavy industry, et cetera. But I think you're also seeing this increasingly on social issues, particularly around the workforce, particularly around racial equity. I think this is in many ways only the beginning of the sort of active shareholder engagement we're going to continue to see on these issues.
Well, yeah, the last season, and my colleague Amy Cortese is on the call, we've done a great job of reporting and covering the sort of stunning successes. The Exxon was sort of the capper, but these shareholder resolutions, which used to be, frankly, when I was a young reporter, sort of symbolic in some way, are really kind of biting. And I think you have the attention of the companies. The strategic question that I put to you earlier, and that's kind of at the heart of all this, is how do you get companies to do things that may well be in the benefit of the planet, may well be in the benefit of the entire portfolio, but may not always be in the benefit of that company's, at least short-term performance? And so how do you actually get companies to do things they may not want to do and can investors actually play that role?
I think we've reached a point, particularly with climate, but other issues as well, but particularly with climate, we've reached a point where fundamentally transforming your company, fundamentally transforming an entire industry is less risky, less costly in the long term than not doing so. We've already warmed the planet 1 degree to prevent 1.5 or 2 degree warming scenarios. We're investing something like $50 trillion of incremental capital in transforming industries from transportation, agriculture, how we build our cities, how we move people and products around. And it's the companies that are building the technology that will enable our society, our economy to transform, building the business models and supply chains. They will be the companies that lead. And those that don't will be left behind as government regulation shifts, as public sentiment, consumer employee preferences shifts, as innovation changes and supply chains and cost curves change. And so, this is obvious, but often forgotten. Companies look the way they do today because of decisions they made 5, 10, 30 years ago. The average age of an oil field is 15, 30 years. The average age of a factory in the US right now is 20 years old. And so the question for companies today and the investors who own them is, how do they make the decisions today that will best position them for a world that will decarbonize, will meet the demands of climate change? And how do you, as a business owner or a business manager, how do you reposition yourself effectively?
So you're not looking for alpha outperformance from new oil pipelines and whatnot. The Exxon campaign, as you explained to me, was done on what people call the hedge fund side of Engine Number One's business. You've also introduced now this this broad ETF. I think the ticker symbol is vote. That's not a plug for it, but I think that's how you find it. And it keys on voting. How does that work at the broad index level? Because that's where, as we were saying, a lot of all of us 401k holders and others can kind of see it in play.
One risk of the ESG investing movement today is that in many ways we have decoupled the growth of ESG investing from ESG outcomes. So we see this exponential growth curve on, say, commitments to the UN PRI. $100 trillion of investors have committed to the principles of responsible investing. And you try and see evidence of that in emissions, in inequality or wages or diversity or pay ratios, obesity rates. And in many ways, the risk right now is that we are seeing evidence of stakeholder capitalism everywhere but where it matters, which is in the actual lives of stakeholders. And from Engine Number One's point of view, I think one reason why we're seeing this is so much of ESG investing is focused on an investor's exposure to certain companies or certain sectors, rather than an investor's impact on that sector. I mean, in many ways, we are an odd firm to call an impact investor or ESG investor because ExxonMobil is one of our largest positions. But we take the view that if we can be responsible, active owners, we can have greater impact. And that can happen through an active fund, or, as you referenced, it can happen through an index fund. So Vote, our Transform 500 ETF, the Engine Number One Transform 500 ETF, owns the 500 largest companies by market cap, no exclusions, no reweightings. It is not an ESG fund by what it holds. It's an ESG fund by what it does. So the way it casts its votes, the way it engages with companies, management teams, with boards, all around the idea that investing in stakeholders, having greater transparency and accountability around impact is both good for that company, good for investors, good for the company's stakeholders, and good for society.
I think I noticed the other day you put out this new framework. I imagine you're also going to the SEC to get, the SEC is looking into ESG, and this is whether a way to demonstrate, the ESG-ness of that fund. So I think we're going to put the link in the chat, and people can check that out. But that's actually a good segue, Michael, to Marcela at Zevin. And Zevin has been an activist shareholder for quite some time, and in a sense has taken this shareholder activism as sort of the core of its, I think, more ESG selection, right? I mean, you're picking companies that you can go also have a impact on. Isn't that right, Marcela?
That's right. And ESG and impact is part of our process. And for stock selection, we certainly look at exposure to risks that the company could have now or in the long term. And that's, from the outside in, right? We also look at the inside out, at the impact that companies are having in the world. Just to echo what everyone on this panel was saying, I have the advantage of having heard all of you, so now I can comment back on some of it. Yeah, we've been around since 1997, and since then we are known for researching and mainstreaming emerging ESG issues that are also impact issues, but it's before they become priced in, before they become a risk to the company, long before it's been an impact, like climate change, right? So we have, like you said, David, at the heart of our approach to investing and advocacy is to engage with stakeholders. So what we do is once we have selected a stock and we did our due diligence, we also want to understand their impacts and who is experiencing those impacts. So we regularly consult with leading environmental advocates, with human rights experts, with labor groups. And that informs changes to our approach to how we're going to approach a company and what is our ask. And there isn't always a business case, right? I can talk a little bit about that too, but these relationships are super important for us to ensure that we are really understanding on the ground and at a systems level what is happening and what needs to happen.
Well, one
We
of
also-
the, oh,
Go ahead.
sorry, excuse me. I just wanted to steer you a little bit to one of the examples we discussed the other day, and which does come up out of, as you say, out of the stakeholders. And as we said in the last call, the sort of first among equal among stakeholders is the workers, and you engaged Amazon quite directly. Maybe you can tell us a little bit how that played out.
Yeah, sure. And I have a couple more examples on that. And with Amazon, it was really on behalf of Amazon workers. Like, we all saw Amazon has been experiencing a huge churn of employees due to a number of reasons. But number one, their fancy algorithms have not focused on the human experience around the pandemic. So we actually filed a shareholder proposal asking for an independent director, because we think that Jeff Bezos simply moving from the CEO position to the board chair role isn't really going to change things. And the company has been saying that it wants to be the safest place to work. And that's not what we have been seeing at all. So for that campaign, we consulted with Amazon workers themselves and groups that represent Amazon workers to really understand what needs to be brought up at the board level, at the annual meeting itself, but also what kind of policies need to change. And we thought, look, things have not changed under Jeff Bezos' guidance. We need an independent board chair. The incoming CEO is really not going to change a lot, and voices aren't going to dissent with what the chair is saying. So that was a really focused, worker-focused campaign. And just to give you another example of how we partner with groups, obviously the racial justice work that Zevin and many other investors and groups have been working on centers on people, right? So who are the experts there? The NAACP, Open Mic, Freedom to Thrive, Worth Rises, Color of Change, and of course the movement for Black Lives. And what has affected them? What type of changes do they want to see beyond companies just setting DEI goals? So that's really important. The example is coworker.org is an organization that partners with workers. We got them to give us really insight into what Alphabet needed to do to improve their DEI performance. And that was very successful because we were able to craft a shareholder proposal that directly reflected their concerns.
One of the things that comes up in all of these discussions, and I imagine that having the stakeholder groups, the NGOs and others, as you said, advocates, they're concerned about this is greenwashing. And how do you think about, and you mentioned net zero, and people have called out, net zero pledges of, various flavors, and some are more or less rigorous. How do you actually just think about whether that issue is whether greenwashing is actually undermining a lot of these ESG initiatives and sort of undermining the credibility?
Yeah, look, there's all kinds of labels for funds and managers that are saying they are doing ESG and their impact firms. And, how do you separate it? On one hand, are they doing ESG across the board or just for certain products from, if you're doing your due diligence? Also, if you're doing your due diligence, what is the process that they engage in? Asking tough questions. It will very quickly tell you what managers are thinking and the depth of their engagements. I completely agree that starting with risk is very important. But we're very quickly, like Hiro's comments and others here are emphasizing is that we have a situation where we always want to seek a win-win with a business case to get companies to make a change. But the reality is that there's not always a win-win. So what are firms doing that have advocacy programs or stewardship programs to make those changes? I think that that's where you really see how seriously investment firms take these systemic risks. There isn't always a win-win. Sometimes we engage with stakeholders who are asking us for the moon, and we understand the business more closely than them. So it's a process of educating each other, and we want to find common ground. It's not easy, but we want to get to addressing impacts as well as ESG risks. And it's much easier to address ESG risks when you have a solid business case.
Okay, so now I think we've got the table laid, and thank you all to all of you speakers. I want to open it up, first of all, to the speakers, especially the early speakers. Marcela got to hear everybody first, but those of you who went earlier, if there's thoughts you have, Chris, maybe you have some broad thoughts. It just strikes me that the themes that have emerged, again, universal owners, risk, as Marcela just said, stewardship, and then really accountability as well. And then maybe this debate over whether it's going to be good for the company, or maybe the company has to be forced to do something that they may not actually want to do. So, Chris, do you want to have a thought? And then I know folks have been putting questions into the chat, and Dennis will help tee some questions up.
Yeah, sure. I mean, just themes I'm picking up from this conversation are in the shift where we want to see shareholder engagement going to have a more systemic impact. Michael's phrasing around shifting from exposure to ESG risk to having an impact on the actual ESG outcomes, that fundamental shift in frame. This fundamental shift from purely looking at things at an individual security level or alpha to the framing around beta and the health of the economic systems that underlie the performance, who's not just beating the index, but the health of the index itself, as Sara and Hiro spoke to. And I feel like underpinning all of this is taking this from the abstraction of investment outcomes to like the human impacts. How is this holistically impacting people's lives? Their lives are impacted by their investment portfolio, but much more by the job and the quality of life in their communities and the health of the planet. And so extending our prism of fiduciary duty to these, holistic impact on beneficiaries' lives. And so I welcome feedback from the rest of the panel on what of this resonates, and looking forward, like how do these shifts keep moving in the right direction?
Treasurer Frerichs, Michael, is there anything that you've heard after your comments that strike you as important, or that maybe even changed your perspective a little bit?
No, it's good to see more people having the same idea, pushing in the same direction. I've been trying to follow the conversation and follow the chat. And for those of you who are able to do both, congratulations, you're more skilled than me. But I think we have seen over the last year or so a big change in where assets are being managed, what kind of funds. We have talked for a while about ESG, and we talk about it as something different. We talk about it in our office, something that's layered on top. But this is becoming the norm for where people, institutional money is flowing. And I think, we run the risk of talking about something separate here, and people think it's something different. This is something that should be part of all investors out there, and the money is following it. If you look at the numbers, where it's going.
Other speakers, Sara, Marcela, Michael, Sara, you got your hand up.
Using those chat features. Yeah, I'm just noting too, as I also fail at multitasking and trying to pay attention to both the chat and the conversation, there are a number of questions around the public benefit corporation forms. I just want to state really quickly, since there are a lot of misconceptions around what that entails. All that really does is it allows companies to pursue broader shareholder interests than narrowly defining those by stock price and sale price of business assets and so forth. It allows them to think a little bit more broadly and frankly, honestly, about what the vectors are of shareholder return. And so it doesn't change anything about the fact that the corporate board is still working for shareholders and owes its fiduciary duties only to those shareholders. Really, it just allows for a deeper, better understanding of what fiduciary duty entails. So I just wanted to clear that up really quickly.
So public benefit corporations in many states, I think 38 states or something like now, that let companies enshrine their mission and their stakeholder commitments into their charters. Dennis, do you want to sort of round up in the thematic focus of the questions? I've lost track on the chat as well.
There's a ton, and thanks everyone for engaging. Actually picked out a couple specific ones because I think they help sort of drill down on some of the conversation. This one from Jerome Tajir to Sarah. How do you incentivize asset management teams around beta stewardship? Another one from Doug Chia to Michael, trying to tease out the model for your success. To what extent do you credit sort of the decades of work that came before your efforts and building on that versus sort of learning from what failed and pushing it forward? And then to everyone, Cameron Niazi had a question about how do multinational corporations push for a better stewardship of ESG in developing countries where many of them operate but may not be located?
All right, let me make the executive call here, and Michael, why don't you go first on the campaigns and what's learned and what works?
Yeah. I mean, there was a comment from one of the asset owners who was with us on the campaign after the successful election. There was something to the effect of, if only so many investors are not divested, because we had 3 out of the 4 nominees we put forward were elected to the board. And so I made this argument, if only so many investors are not divested, maybe we could have gone 4 directors, if only weren't for the divestment movement. I kind of take the view, if it weren't for the divestment movement, we might have gone 0, because it's only been through the work of decades of other investors, activists, the broader ESG movement that has forced these issues so center stage that by the time that we were able to make the strong economic argument, the corporate governance argument, put forward this slate that we did, that big investors, big institutional investors like BlackRock, Vanguard, State Street, big pension funds, other asset owners, in many ways, they've been well primed for what ultimately happened. So it was only through in the public markets, we only owned some small portion, 2 basis points of the stock. It's a team sport. So it's only through the collaboration and the coalition of others that any of us can be successful in having any impact on the companies we engage with.
I know that one of your early backers, and I think sort of a mainstay, was CalSTRS. They were very public early on. Chris Ailman at CalSTRS and Hiro Mizuno at the GPIF and others have put together this remarkable letter. Came out about a year ago, just sort of at the beginning of actually in the spring, just at the beginning of the pandemic, as I recall, on the sort of responsibility of institutional owners. Hiro told me that they had 3 signatories originally, and now they have 15. I don't know whether, Dennis, we put that link in there, but that letter is worth a read. The second, I think it was the first question that you said, Dennis, but the second question was go to Sarah about, I think, incentives for how to enforce voting rights, among other things, enforce voting behavior among the asset managers, right?
Yeah, and really, again, this is just about the sort of dual direction of travel. I mean, one incentive I would hope would be the understanding, that educating them about the proper understanding that this is a value proposition. You don't really have to change much about what it is you're trying to do. Just understand that there's a better way to do it. And then in the other direction of travel, for asset owners to start writing this kind of requirement into their mandates would be a massive incentive. And the more of them who do so, the better.
If you listen to Hiro, you heard him say that they ask the asset managers, why did you vote that way on that issue? And I asked him in the call, do you think you had some influence? And he didn't quite answer, but he's basically said yes. And I've heard from other asset managers, yeah, we get our annual stewardship report card from the GPIF that ranks us, and that's now one of the signal things he did there was raise the percentage of the grading criteria, of the ratings that they give to the asset managers on stewardship and then sort of let them know what they expected. And so I don't know whether, Michael, you know, whether that was significant in flipping these votes, but these asset managers know they're being watched now by at least some of these universal asset owners.
Well, and there's maybe one more step in that chain too, which is a legitimate one to recognize, which is a practical one. If an asset manager decides to start doing this really in earnest, then there's this giant gap in the value chain, in that most of them rely on proxy advisors for their advice on how to vote and so forth. And they need that. I mean, there are tens of thousands of corporate actions that they have to vote on every year. And right now there's no advisory product that takes a universal owner lens. So that's something that we're working on too at the Shareholder Commons, is a tender for proxy advice that does take that lens. And we're hopeful that that can also provide some of the incentive to fill in sort of a gap in the market.
So universal owners help is on the way. The last question, Dennis, if I understood it, was sort of about regulatory scrutiny, and also particularly like developing markets, and in particular multinational companies who are working in many jurisdictions with, you know, different regulations and different rules. I don't know. Is that a Marcela question? I don't know who wants to take that on. Or Michael Frerichs. I mean, the regulatory questions. You're working, I know, with the SEC on a bunch of disclosure and other policy changes.
Yeah, I'd say that the Trump SEC change on proxy advisors didn't directly impact me, but there's an indirect impact if they shut down the work of a lot of union pension funds out there, a lot of RISA funds. And those two proxy advising firms have to go to business, right, to change their funding model or greatly increase their prices, then that does hurt state treasurers like myself, because we go through an awful lot of these companies, and you know, we need help. I have a limited staff, and so we rely on them. We've been petitioning the SEC to make some changes. I've been lobbying Congress to make sure that that legislation or that rule is not funded. But really, I hope we get to a point in the future where ESG is just something that people take for granted. It is analysis. It is layered on to technical financial analysis, but it's another level of risk analysis. And that my hope is that this conversation disappears for the next few years.
Terrific. It's the top of the hour. Obviously, if you have other things to do, you're don't let me stop you from going to those. But if you can stay, we'll just keep the conversation going a little bit longer, and then then I'll step back and we'll have what veterans of these calls know is sort of the happy hour. We think of it as sort of hanging out in the lobby after the show is over. But let's just have another couple calls before we let you all, questions before we let you all go. And we also have a special message from Hiro and our friends at the GSG Summit coming up. So when you see that might be your clue to duck out. But Dennis, is there anything else, or does any of the speakers want to make a point that we didn't get to?
I just flag one question, good question from Andrea Armeni. About the interaction of activist investors and activists in social movements. And Marcela, you mentioned sort of taking some of your cues from activists. To what extent is there sort of accountability between these shareholder initiatives and the movements that they're purporting to support often?
Accountability back to the investor?
Back to the movement. So I mean, I guess maybe just talk a bit about how you do engage with activists in social movements.
You know, outcomes are really hard to attribute for any impact investing practitioners here. And so we rarely say that Zevin single-handedly achieved a change. It's really, we are, you know, like Hiro said, our portfolios and companies and us, we are not hermetically sealed. So we need to work symbiotically in the long term to move in the right direction, but we need to inform each other on what that direction is. I was really struck by the name of this call, Capitalism Reimagined. And I mean, I just want to make a comment on that, because I do think from my perspective, until we reimagine capitalism, companies are going to continue to pursue their own self-interest, right? So we need to identify ways that they can ultimately transform their business so that they are taking into account stakeholder impacts in the design of their services, their products, and then we go from there. And I really think that involves pulling a lot of different actors together, including the proxy advisory firms, because they are, I think, lagging in my view on how they're advising. I wanted to mention Majority Action is another NGO that we work with, and they're providing feedback to ISS on how they're evaluating climate risk. So that's one example of other work that we can do in unison. So accountability, not sure if that's the word, but it's more attribution and collaboration rather than attributing it back to us.
This attribution question is a perfect setup. I see Kathy Clark on the call for the call that we're going to do in 2 weeks, which is going to be about impact measurement and management. In fact, some of these very thorny questions that have been raised here, Kathy will have some practical how-to advice for us. I guess I want to bring this to a close. I think I'm remiss in not having urged you all, if you're not already, to subscribe to ImpactAlpha, which you can do at impactalpha.com. Subscribe. Zulema, do we have a special offer for folks? Or we just ran a little campaign just now. I'm sorry to put you on the spot here.
You can save $100 on your annual subscription, but also do email us. We want to get your whole team on board. And so we don't want you to pay individually for all of those. So do contact us and we'll get you on the right plan.
That's actually sort of a new initiative, not new, but we're putting some pressure, some muscle behind this. We found that everybody was burying their subscriptions in their corporate expense accounts, and they should just get the accounting department to do the subscription. So look for ImpactAlpha for teams. And I would just want to thank everybody again, the speakers. As I say, we're gonna close with a minute or 30 seconds or so, just to promote this GSG summit, where I have another conversation with Hiro Mizuno, and then we will leave the room open. I will try to. I think I'll turn my screen off, and maybe Dennis and Zulema, if needed, you can help facilitate a little bit. But really, there's no facilitation. It's really just hanging out. Anybody can pipe up, keep the chat line open, and we'll have, as Zulema said, the video of this call, as well as a little roundup and some of these resources and whatnot. It's terrific to see you all. The chat, I finally got a chance to scroll through it. It's amazing, and the gallery and all of you are amazing. So thank you very much. Isaac, you want to roll that second tape?
Hello, I'm Hiro Mizuno, a UN Special Envoy on Innovative Finance and Sustainable Investment. At the GSG Summit in October, I'll be speaking about the concept of universal ownership and talk about how to minimize negative impact of the investment activities and a positive impact of the investment activities. So please join me. I'll be looking forward to talking to you then.
There you go. Okay. Thanks, everybody.